On October 19, 1987, the stock market experienced a significant decline, with some estimates suggesting around $500 billion in stock market value evaporated, and the Dow Jones Industrial Average dropping by 22.6% on that day. Margin debt is a type of borrowed money that amplifies stock market losses, turning a dip into a crash. As of recent years, margin debt has reached record highs, with some reports indicating it surpassed $814 billion in the U.S. in 2020. The practice of buying on margin has been around since the early 20th century. We'll explore how margin debt creates a mechanical chain of forced selling, which can lead to significant market downturns. This phenomenon can have far-reaching consequences, including increased market volatility and potential losses for investors. A significant drop in stock price can trigger a margin call if the investor has borrowed a substantial portion of the stock's value. Brokerages can liquidate securities without notifying the investor if a margin call is not met, which can lead to further market declines. While many investors view margin calls as a necessary evil, they can actually create a self-reinforcing cycle of selling that exacerbates market downturns. Studies suggest that this cycle can be particularly damaging during times of high market volatility. The 1929 stock market crash was exacerbated by margin debt, as investors who had bought on margin were forced to sell, leading to a cascading effect. This event highlights the potential risks of margin debt and its impact on market stability. It's estimated that a substantial portion of stocks were bought on margin in the lead-up to the 1929 crash. The crash led to a significant drop in the Dow Jones Industrial Average, with some estimates suggesting a decline of around 47.9% over a short period. The 2008 financial crisis saw a significant increase in margin debt, which contributed to the severity of the market downturn. This event highlights the importance of understanding the role of margin debt in market crashes. Margin debt peaked at around $389 billion in July 2007, just before the crisis. The S&P 500 experienced a significant decline in 2008, with some estimates suggesting a drop of around 38.5%. While many factors contributed to the 2008 crisis, the role of margin debt is often overlooked, despite its potential to amplify market losses. This oversight can have significant consequences for investors and market stability. The impact of margin debt on individual investors can be devastating, as they may see their entire portfolio wiped out due to forced selling, even if they've taken a long-term approach to investing. This highlights the importance of understanding margin debt and its potential risks. The 2020 market crash, triggered by the COVID-19 pandemic, saw a rapid increase in margin debt, which contributed to the speed and severity of the downturn. This event highlights the ongoing relevance of margin debt in modern markets. Margin debt rose by around $100 billion in the first quarter of 2020, as investors sought to capitalize on market volatility. The S&P 500 experienced a significant decline in 2020, with some estimates suggesting a drop of around 33.9% over a short period. A significant drop in stock price can trigger a wave of margin calls, leading to a cascade of selling. This chain reaction can be triggered by a single event, such as a major stock market index falling below a key level, and can have far-reaching consequences for investors. Margin debt creates a mechanical chain of forced selling, which can lead to devastating market crashes, as investors are forced to sell securities to meet margin calls. This phenomenon highlights the importance of understanding the risks of margin debt and taking steps to mitigate them. The combination of margin debt and forced selling can create a self-reinforcing cycle of selling that exacerbates market downturns. This cycle can be particularly damaging during times of high market volatility, and highlights the importance of diversification and risk management. The 1987 crash saw a significant drop in the Dow Jones Industrial Average, with some estimates suggesting a decline of around 22.6% on a single day. The crash was triggered by a combination of factors, including margin debt and computerized trading, and highlights the ongoing relevance of these factors in modern markets. In conclusion, margin debt can turn a market dip into a crash, as we've seen in numerous historical examples. It's essential for investors to understand the risks of margin debt and take steps to protect their portfolios, such as diversification and risk management. One key takeaway from this video is that investors should carefully consider the risks of margin debt and forced selling, and take steps to protect their portfolios from potential losses. This can include maintaining a cash cushion, diversifying investments, and understanding the role of margin debt in market crashes. If this changed how you think about money, subscribe for more educational content on investing and personal finance.